Mic test. All right. Hi everyone. Hi, Mohammed from Algeria. Yeah. Okay. So as you guys can see over here on the screen, today we're going to talk about some of the advanced technical analysis, and today I will try to do it as quick as possible. Why? It's because I know today we have one of the most important event this week, which is the FOMC rate decisions. If it's not the most important thing of this month, okay, I will give you guys some time, to consider and then to place your trade accordingly. But of course, too bad today's sessions we are not going to touch any of the informations regarding the FOMC's rate decision. Okay, but yeah, if we have time, towards the end of the sessions, maybe you guys can ask me questions and I will share my trading ideas with you guys. Okay. So today's we're going to talk about some of the advanced technical analysis. So this is the rundown. I'm going to talk about very simple how to identify some of the very common or easy to spot continuations and also reversal structures. Okay. Yeah, it is not really like textbook. Okay, it requires some of the experience for you to figure it out whether or not this is the continuations or reversals. Okay, yeah, we will discuss it today, and also like how are you going to confirm the trend with the help of the Fibonacci retracements. We have been talking about this for many times, so today I'm not going to discuss in depth for like what is Fibonacci, what is the rationale behind it, what's the logic, and how to use it. I will quickly go through this Fibonacci retracements, and also later on the last part, I will introduce you guys Ichimoku Cloud. Okay. I'm not sure. We have a lot of people today. I'm not sure. Is everyone um is everyone familiar with the Ichimoku? I see Michael said you can't hear me. Is everyone can hear me well? Or is only Michael? Maybe you can tune up your speaker. Yeah. Yeah. Okay. Cool. Yeah, and then I will share with you like how I use the Fibonacci this Ichimoku Cloud. Okay. Right now, let's dive in. Okay, first of all, identify continuation reversals. I'm going to share with you not only some of the very typical candlestick patterns in that may probably you can spot it in the markets, but rather what are the rationales? Okay, what is the logic behind this, and what traders thinking and resulted this kind of price pattern. So I don't want you to, really, for example, if maybe you will come across like head and shoulder price pattern. It's not sometimes like go exactly like a sharp, really like a mountain kind of two shoulders and then one head very nicely. Only you can consider it as a head and shoulders price pattern. So, and I just want to share with you really my thoughts, like what is behind this, and then in the future maybe you can spot something similar. You guys can tell, and also like how to react after you spotted those patterns. Okay, whether or not this is like a momentum shift or is a continuation of a momentum, and try to figure it out whether or not people already stop dumping, stop selling, or this is like a false signals, just want to fool people, but then later on the trend is going to continue. Okay, so this is the triangle price patterns, and if you trade long enough in the markets, you definitely will spot this kind of triangle pattern. Especially remember, I think recently, I mean like few months ago, it happens with gold chart. It happened this way, and I just want to share with you what leads to this, and then if you can digest these ideas, perhaps in the future you can able to react quick enough, and when this picture come again on the chart, then you can already start to plan your trade. Well, of course it come with the risk management with the stop loss and TP. Okay, so for example, you have to imagine for the first one on the left hand side, this ascending triangle. Okay, you can imagine that this here is already an established uptrend. Okay, it has been like going up. Of course, sometimes when there's a noise over here, when it comes to here, here is a very strong resistance. Okay, very strong resistance, and every time when it hits here, most of the people in the market, okay, believe that this particular, okay, for example, gold, okay, it shouldn't go beyond this level because will be too expensive. Okay, so every time when it hits here, they sell, hit here and sell. But you can see when time go by, if people believe that this gold worth uh a lot more than previously. Okay, previously it come from here. Okay, and then when they sell to here, people thought, oh, that is cheap enough. Okay, I want to buy, and then just go buy. But until here, then another big group of people might think that, oh, it's too expensive. They will start to sell. But second time when they sell down, more people come to these price levels. They think that yes, this is like a cheap enough price for the gold, and they will start to buy in. Okay, so this is like the logic behind this price pattern. Okay, and then at some point you can wish um more and more people believe that the gold worth, okay, much more expensive than the levels here, than the price levels here, and then eventually it will break up. When it's break up, it will be like a free fall for a while. Okay, but okay, I want to share this with you. It's not 100% true. Okay, of course, this is people we call this as a continuation patterns. But if you have enough of experience in the markets, you know that sometimes when we're already forming this kind of price patterns where we have a flat resistance line, and yet at the same time we have like a higher low price patterns, it could lead to a sell down from here. Okay, if it does sell down from here, then we call it as a reversal. Okay, this will be more complicated rather than it break up from here. Okay, that will be a more common textbook continuations price patterns. And if you do your risk management well, okay, which means that you very disciplined, you set your stop loss and TP, it is fine, right? Because maybe for example, out of 10 times when forming this ascending triangle, a break above happens like 6 to 7 times, where a break below happen 3 4 times, and you know that your winning rate is still higher, right? So if you aim to trade with the breakup, okay, meaning to say you place your order over here, okay, you enter, this is your entry point, and you can easily set your stop loss at the previous low. And if you have like holding your principal like 1 to 1.5 or 1 to 2 the profit ratio, okay, the win-lose ratio, then you can set accordingly to the the take profit levels, and or you can refer to the previous resistance if that is available. Okay, then can set accordingly, and I bet that if you do your risk management very well, out of the 10 times, most of the time you're going to win. All right. And similarly, okay, vice versa. If this is like a descending triangle pattern, what is the logic here? Okay, you have to imagine that the gold has been selling down, okay, selling down, people keep selling, and up to this level, people believe that now we come to these price levels is cheap enough, and people start to buy in. But when people start to buy, and when it comes to these levels, people already start to feel this is like too expensive, and they will start to sell. More people selling than people buying. Okay, and then again, so when they and when they start selling, come to these levels, then they thought, oh, it's cheap enough. Okay, people start to come in and then buy. This is why it leads to a rebound. Okay, but this time around, it's even lower. Okay, people believe that now the gold worth less than the previous period. Okay, worth less. Okay, so maybe at some point over here, more seller come in than people wish to buy. Okay, then it will push to break the previous low here. Okay, then it will be like a bearish breakout. Of course, it was previously have a big sell down and then gradually sell even lower. So this is like a continuation of a bearish trend. All right. So of course, it happens like this when ascending triangle. It also happens to break below. Same goes to the descending triangle. Sometimes, okay, when it break up again, okay, and then recorded like a higher high from here, then this will be a very nice bullish trend reversal signal for this particular asset. for example. But same, if you do your risk management very well, this is your entry point, and then this is your stop loss, and then you set like 1 to 2 for your win-lose ratio, or you refer to the previous support line, then I would say this is a very good practice, okay, the very disciplined practice. Out of 10 times, if you win 6 to 7 times, if you lose just 3 to 4 times, ultimately, okay, in the long run, you will still be making profit. Okay, but what is more important, okay, what is more confusing will be the asymmetric triangle patterns. Okay, so it could break either direction. So this one, it requires you to have a sufficient experience in the markets only for you to trade with this kind of pattern, because it can either break up or even can break below. Okay, first of all, it may be, okay, the chance will be high. It depends on where it come from. Okay, if it come from up to down, okay, it means that if it has been dropping up until these levels, and then it start to consolidate and form this asymmetric triangles, then the tendency for it to drop further, okay, the chance is higher. Okay, vice versa, if it's come from bottom, okay, it start to gain, and come to this point, and it's turned out to be very indecisive. Okay, and then people like start to buy and sell, undecided with the price levels, okay, undecided with the upcoming directions, the tendency for it to break above is higher than it break below, because people always like keep buying it until these levels. Just that at this point, we have some of the different opinions, and sellers start to come in, start to sell. Okay, it's like stir up the markets, but eventually maybe more people believe that this particular asset worth higher price. Then yeah, it will lead to a breakup. Then it will be the continuations of the price. Okay, so this is the logic behind. So we have to know what price, why at this particular level people start to sell, why at these particular levels people believe this is cheap enough and then start to buy it. Okay, so this is the story behind every single price pattern. So this is a very typical triangle price patterns. I hope that, and bet with me, it's not going to be as nice as this, okay, in the markets. Okay, you don't have like for example, the gold start to hovering around here 4K nicely. Okay, it could be like 4015, 4025, 4005. Okay, it cannot be like a straight 180-degree horizontal line. Okay, and then sometime the uptrend, okay, or the downtrend will not be like very smooth. Okay, the slope will be very nice. Okay, it will be a bit choppy, but then we try to find the patterns. Okay, what we want to know is to understand behind the trader behavior with the price and also with the volume. Okay, and then moving up next, this is also quite common. Okay, I think most of the people here, if you trade long enough in the markets, you will spotted some of this kind of patterns. So they share a very similar um logic behind. Okay, the flag and the pennants, I mean, they are the same, right? They are the flag. So yeah, this is also a very typical continuations price patterns. Okay, meaning to say, when this is an uptrend, okay, later on I will show you guys some of the real life example with the flag and pennants. Okay, hope that you can have the reference. Okay, so the logic here is the same. Like people start buying it, and then the price keep going up until certain level. Okay, more and more people like scared, right, when the profit taking sentiment kicking. Okay, so like for example, people A, okay, the trader A start to sell over here, and like everyone start to buy over here, right? Buy, hold your positions up until here, and this is the first buyer, and he got shocked, and then he think this is like too high. Okay, he start to sell. All right, when he start to sell, and then we'll have a bunch of people believe that, oh, this is still have a trend. Okay, this maybe they top up. Okay, they leverage up. Okay, some of the people here believe that this is cheap enough, I want to leverage up, so they start buying it, and then goes up here. So here come the second traders. They have got hit by these profit sentiments. he cannot sell here, and he say here is good enough for him, so he start to sell also. So he start to sell and sell even lower. Okay, so like during these two downtrend, like the panic selling start, okay, for a few of the trader, okay, they start to have like a panic selling, they sell, and over here, some of the people come in again and say, oh, here probably is a very good price, okay, for a leverage up, and then it was people come in and start buy, or those that fail to enter here, fail to enter at a very nice entry point here, and then they thought maybe they can have four more hits, and then they start to buying in here. Okay, so when like those that hit by the panic selling, okay, already start to sell, and when the selling pressure eases, and this is like a real trend, right? When the real trend, most of the people in the market believe this asset price worth higher, okay, worth much higher than just here, and eventually it will have more buyer comes in and push the price even higher and break above from this downtrend channel. Okay, similarly with here. So this is like an indecisive, like have different opinions here. So you start to have like buyer, seller, buyer, seller, buyer, seller. And eventually, if this is a strong enough bullish trend, it will eventually push the price higher. Okay, so these are some of the very typical continuations price patterns. Either it is like a bull one or a bearish one. Okay, bullish, bearish. So next time, if either you already enter your position here and you spotted something, it is not like a huge sell down. Okay, it's like not like the 90-degree sell down. Okay, then you rest assured. Okay, if this is like just a minor correction, consolidate, and you when you spotted this in the future, then you can rest assured, believe that later on, the price will break higher. Okay, same goes to here. If you already managed to enter a sell position here, okay, enter a short position here, when this is like a slight technical rebound happen over here, rest assured, okay, because you already know eventually the price will sell to a lower price level. Okay, and also if you fail to enter any position here, okay, you don't hold any positions, and you already know this is like a very bullish trend, and something like this happens, then perhaps you can also tell that maybe I enter here, I still have a bit of profit for me to enjoy, because I know the bullish trend is not only here, but will have a second rally. Okay, so this is also for your second chance. If you have a bit of a formal sentiments, then this will be the entry levels for you. Okay, of course the risk is greater than if you enter here. Okay, definitely, I'm not going to tell lie. Okay, this is just share with you. If you already hit by the FOMO and then you spotted something, maybe you can give it a try, but maybe you can set a tighter stop loss price level, stop loss order, okay, and then you can acknowledge that the risk here, okay, when you enter here is greater than you enter here. All right, so this is the logic behind. All right, and up next, this is the reversals patterns. Okay, reversals, this is like a head and shoulder, double top, triple top. Okay, yeah, same. You don't expect the price patterns happens exactly like this. Okay, exactly like this. It's not really going to happen like one to one. Okay, but if you spotted something that resemble this kind of price pattern, you can kind of tell this can be a reversals patterns, then you can get ready to enter. All right. So the logic behind this is that already have a higher high. If this one fail to have a higher high, okay, if this high go up here, then this is like a continuation price patterns. All right, but if it's not, it fail to record a higher high, then it's meaning to say the bullish momentum is easing. Okay, it's meaning to say, and more people here now believe that this asset doesn't worth this high price. Okay, it worth a cheaper price. Then it will have more people come in to sell down. Okay, so this is like a very typical psychology hit, and this is like a very typical reversals patterns. Okay, double top is the same. Double top sometimes it will lead to a triple top. Okay, so this is not how to say, very 100% sure of a reversals patterns unless a triple top. Triple top will be like a more certain reversals pattern, because sometimes when there's a double top and for the third time round it can break high. Okay, so the risk is there. I want to share with you. The risk is there. And triple top is a safer entry levels. Okay, when you spotted a triple top or a triple bottom, you can feel a more safe to enter somewhere around here, above the previous high, above the below the previous low. You can enter somewhere around here. And then very easy, you can set your stop loss at the bottom, I think, at the previous bottom or the previous top as the stop loss, and then you can do your TP like 1 to 2 or 1 to 1.5. Okay, depends on your principles when you trade. Okay, so this is the very typical reversals patterns. Why I share with you the reversal patterns, I will share it with you, and when you use it along with the Ichimoku Cloud, then it will make more sense. Okay. Thirdly, a rising wage, okay, or a falling wage. This is more confusing. Okay, it depends on where it happens. Okay, it happens, okay, because it has like a higher high and higher low, but it getting more and more narrow. Okay, so this is like a wage, all right. Okay, and this is the same falling wage. This is like a lower high and then have a lower low. Okay, but if it happens in amid a downtrend, okay, it happens amid at a downtrend, it might be a continuation. Okay, but if it happens during an uptrend, okay, uptrend like this, you can imagine it goes up like this, goes out until this level, it become like this. Okay, it is still going up, but it's getting narrower and narrower. Okay, what does it tell us? It tells us that, or more and more people is convinced that it is getting too expensive now. Okay, getting too expensive now, and less buyer comes in. Less buyer comes in, and eventually it will lead to a sell down. Okay, a break below. So remember, this rising wage, it depends on where it happens. If it happened at midst of a downtrend, it could be a continuation, continue to sell down. But if it happens during an uptrend, okay, uptrend until here, and when this channel become more and more narrow, it might have a chance to lead to a reversals and sell down. Okay, same goes to here. Okay, a falling wedge. If it happens during an uptrend, okay, and then consolidate, it might lead to a continuation. Okay, but if it happens during a downtrend like this, and then start people like buying in, okay, like the selling momentum, okay, the selling power is getting softer, okay, it's not as strong as previously, it might lead to a reverse, okay, a breakout. Okay, so this is very important. This is really have to depend on where it happens and what kind of price patterns this tell us, this signaling us. Okay, so this is very confusing. You have to be aware. Right, Fibonacci retracement. I'm not going to share with you like what is the logic behind, like how they're going to use it, but I just want to share with you, I admit of an established trend. Okay, when you're not certain whether or not this is like a sell down, this is the reversals, you can sometimes pull the Fibonacci retracement and respect the 61.8 to 50, because yeah, of course, when you talk about the Fibonacci, which is the Italian mathematicians, he found out this very magical 61.8 this universal number. But come towards the modern era, people also at the same time respect this 50% of the level. Okay, and also just to check, also you can use like a 200 EMA line or the 50 EMA line, depends on your back test, to double check the trend alongside with the Fibonacci retracement. Okay, how are you going to use it? Let me share with you. So use this EURUSD for example. Okay, remember I shared with you an inverse head and shoulder price pattern. Okay. Mm, where is my yeah, oh, it's over here. So this is kind of like a inverse head and shoulder, right? So remember, I told you this is not going to happen like exact, very textbook, like a very nice head and shoulder price pattern. Sometimes, based on your experience, okay, you can see this is kind of like a inverse head and shoulder. Okay, when what does it tells us? This is like a reverse price patterns, right? Reverse price patterns, and it already happens. Okay, but if the price it happens up until this level, okay, like inverse head and shoulder and then rebounded, but at this current, okay, the latest development, it come down. Okay, it come down. So how are you going to have like a second confirmations whether or not this is an uptrend or this is like a false breakup? Because no one can guarantee you, right? No one can guarantee you after a inverse head and shoulder price patterns, it will have a very long uptrend. Okay, so very simple. You can pull from the bottom to the top, okay, for with the Fibonacci retracement, and you can see very nicely, remember very nicely, now if the following patterns, okay, the following patterns rebounded. Yes, you can see it rebounded over here. Okay, rebounded over here and on above this 0.5, the 50% of the Fibonacci retracement. Okay, so this means that this is a very nice bullish trend, and this is like a confirmation of this reversal price patterns, and you can feel safe to enter somewhere around here because this is like a confirmations already, and you can hope that the rally can go even higher. Okay, so you can see eventually it continues to go higher and higher. So of course, in between there are noise. Okay, there are noise. Yeah, but this is like as a confirmation. The second one also, okay, if I exit from this, okay, so remember this is like a Fibonacci retracements, right? And the seconds, if that is like a second drop, okay, the second retracement, you can do the same thing, pull up the Fibonacci retracement, okay, with the previous uptrend from the bottom to the top, okay. You can see very nicely, it just supported on above the 61.8 Fibonacci retracement. And at here, if you want to average up, you can, okay. Okay, this means that you already spotted this reverse price patterns, and then you use the Fibonacci retracements to confirm this uptrend. Okay, and then remember I show you the flag and also the pennant price patterns. Okay, so this is also one of the very typical one. All right, you can see this is like a uptrend, right? Uptrend, and suddenly people start selling. Okay, and then form this um flag patterns. Okay, so if you can see, all right, this is like an established uptrend, and then suddenly have this pennant. Okay, so you can really bet that one day it will break up from here, and then the uptrend continues. Okay, and you can same goes with the Fibonacci retracements. Okay, they pull from the bottom to the top for this entire uptrend, and you can see now it still hold on above the very healthy 38.2 Fibonacci retracements. Okay, and if you go lower and you reach here, maybe you want to give it a try because we respect this 50% of the Fibonacci retracement, and you might want to try it out and give it enter a position, a long position here, and then hope that one day it will break above from this downtrend, these flat patterns, and reach at least above the previous high over here. Okay, this could be the trading plan, okay, for you if you spotted this kind of the price patterns. Okay, so this is means by after you spot those continuations patterns or reversals patterns, if you want a double confirmations of the current trend, you can always pull up the Fibonacci retracements for the second confirmations. All right. Now, this is like what I really want to share with you guys, the Ichimoku Cloud. Okay, so this is like a one-stop solutions, okay, for most of the trader. Okay, so with the help of the Ichimoku Cloud, you can understand the trend direction. Okay, and at the same time can understand, okay, or you can kind of know the current momentum, whether or not this trend is strong or weak. Okay, and at the same time you can find out the support and resistance line at one glance. Okay, so with one Ichimoku Cloud indicator, you can at least get these three informations if you plot this on your chart. Okay, so how are we going to use it? But before I share with you, you have to really believe that the equilibrium. Okay, it means that this the people that invented this Ichimoku cup believe that eventually the price will go back to the equilibrium. Okay, go back to the average price, whether or not it have like a sudden spike, whether or not it have like a sudden dip. Eventually the price will find a balance and go back to the equilibrium price level. So this is the core, okay, the core belief behind this indicator. So if you don't believe this, then I don't think this is an indicator for you. But if it is, then yeah, this is maybe one of the indicators that can assist you to justify, okay, the trend, to justify the momentum, and also help you to find out the optimum support and resistance line. Okay, before I share with you how to use the Ichimoku Cloud, you have to understand that with this Ichimoku Cloud, we have five important line. Five important line. First is the conversion line. So unlike the very common moving averages where it average out, okay, it divided out depends on the period, like what kind of a period that you want to set. And but it uses the close price, right? It uses just the close price. But with the Ichimoku Cloud, the conversion line, it divided by two with the highest price and the lowest price for the past 9 period. Okay, of course, this is like a default setting. You can do your back test, and then if you want to change the parameter, it is fine for you. Okay, but by default, this is from the inventor. Okay, he have this conversion line with the previous past 9 period. Okay, 9 candlestick, the higher price and the lowest price divided by 2. Remember the equilibrium. Okay, the core, the 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 psychology behind this indicator. Okay, then second is the baseline. It used 26 period. Okay, for the previous 26 candlestick, the highest price, the lowest price divided by 2. Okay, so you can see these as the very common moving averages strategies, where when this conversion line cross above the baseline, it means like a bullish trend. And if this conversion line cross below the baseline, it means a bearish trend. Okay, this is one of the signal given by Ichimoku Cloud. Okay, this is the first one, right? The second magic is over here, the leading span A and leading span B. Okay, so the calculation is like this. All right, this is also the quick line. Okay, it use the average of these two line. Okay, average of these two line, plot 26 period ahead. Okay, plot like 26 candlestick ahead of the latest candlestick. Okay, with the latest price, the latest price. Okay, and then the second span, okay, is leading. Sorry for the typo. Leading span B is calculated with the 52 period high and 52 period low divided by 2. So this is like the slow line. Okay, you can treat it like as a slow line. But the magic for the Ichimoku is this two line is plotted ahead. Okay, later I will show you what does it mean by plotted ahead. Same 26 period ahead of the latest price. Okay, and last line, they call it the lagging line. Why you call it a lagging line is because they use the current closing price, okay, plotted 26 period behind. Okay, meaning to say this current price, okay, then this line is how they come up with this line. Okay, how it derive is uses this current closing price plotted back, okay, to behind. Okay, so this is like a lagging line. Okay, why? all this belief that regardless is plotted ahead or plotted behind, the core, okay, the core logic rationale behind the entire Ichimoku is belief that eventually the price will find a balance and it will trade to its equilibrium price. Okay, so this is the core, right? So yeah, the Ichimoku cloud, it look like this. Okay, it is very complicated, very complicated, and but if you understand it, it will be very lovely to use. Okay, because it tells like the futures, right? Remember, it plotted ahead. Okay, it means that it kind of can tell the future. Okay, so you can see the two line, okay, the conversion line and also the baseline. Often it will flow alongside the price. Okay, it most of the time flow alongside the price, quite close with the price, and this is the lagging line. So this lagging line, it is uses, for example, yeah. Okay, for example, the closing price here is maybe derived from somewhere around here. Okay, the 26 candlestick somewhere around here, it plotted here. Okay, the closing price plotted here, closing price plotted here. So it comes up with this lagging span. Okay. And the leading line, okay, the leading line is that they use this period of time, what it derived, it plotted ahead. Okay, it plotted ahead, and it come up with somewhat like it can tell the future. Okay, so it plotted ahead, 26 candlestick ahead. So this is what the Ichimoku looks like, right? So yeah, let me show you. It would be nice if I use a more complicated asset. Then I can show you in a bigger in a better picture. All right. Yeah. So Ichimoku kind of look like things like this. Okay. So if you are the first time user, okay, if you look at something like this, whether or not it will be very confusing for you to use, right? Very confusing, right? Either to me, it will be absolutely confusing. So what does it tell us? To me, this is a signal that I don't trade. Okay, so first thing, I don't trade when the line keep crossing each other. When it's so confused, I don't trade. Okay, now next, let me show you what it means by plotting ahead. Remember, you can look at here. The price is only come up to here, right? But the cloud, okay, or this span A, span B line, it has already plotted ahead over here. Okay, and what is a lagging line? It means it's only come up to here, where here is the latest price, but the lagging price put it plotted here. So this is the lagging price. Okay, so this is what we mean. We have the something plotted in the future, and then we have something plot in the past. So, but we believe that the price will go back to the balance, go back to the equilibrium. So we rely on this. Now, what can we tell? Okay, remember, first of all, we with the help of the Ichimoku cloud, we can tell the trend. Okay, very important. Okay, let's zoom in. The first one is very simple, like what it tells us with the moving averages. Remember, I told you that it's like we can treat it as a fast line and a slow line. Okay, the fast line is the conversion line, and the slow line is the baseline because the baseline use a greater time frame. But the conversion line use a smaller time frame. Okay, a shorter time frame. Okay, there's a cross. Okay, when there is a cross, when the conversion line cross below, okay, cross below from the baseline, it's already give us a signal of a reversal. Okay, give us a signal of a reversal. All right, and if the lagging line, okay, if the lagging line is below of the actual price, right? It means it's the momentum is selling. Okay, it means that the momentum is very weak. It's selling. It's going down. Okay, okay. I'll give you an example. If there is like an uptrend, the lagging line is always on above the actual price. Okay, above. So when this lagging line is above, the actual price, is mean a bullish. But if it's at below this actual price, is mean is a bearish. Okay, so this we already have the second confirmations, right? So we have the conversion line cross below the baseline, and we have the lagging line at below the actual price. Okay, then we miss out the final signal. Okay, green cloud is means still bullish, but red cloud is mean bearish. Remember, the cloud come ahead, okay, come ahead of the actual price. Meaning to say, when the price happen like this, when there is a cross, when there is a lagging line, the cloud is already turned red over here. Okay, so you add up these three signals together, it can tells you, okay, it can tells you now there's like a bearish trend reversal already. Okay, and thirdly, if the cloud is very narrow, okay, it turned out to be like something like this, the cloud is very narrow, then you don't trade. Okay, remember the cloud form ahead of the actual price, right? So when it comes to here, you can see the cloud is expanding. Okay, the cloud is expanding, it become greater over here. Remember, this is ahead. When the price come up to here, it already forming this. Then this is a signal for you to enter a short positions. Okay, when the cloud is thick, okay, when the cloud has a reversal, okay, means from green turn to red or from red turn to blue, green. Okay, when the crossing, when the conversion line and the baseline cross, and also it have a second confirmations with the lagging span line, this is the very strong signal for you. Okay, and I want to share this with you is that you don't use it with a too short time frame. Okay, you don't use it with 15 minutes, 30 minutes, or even maybe 1 hour. This indicator is more shoot to those people tend to hold the trend or hold the positions for a longer time period. Okay, now last one. Okay, remember the cloud is formed ahead, right? So this can be your stop loss also. Okay, depends on you. If you want to refer to the lagging line as your stop loss or TP, it is fine. Okay, remember, like, you already spotted the cross, you already spotted a red cloud, you spotted the lagging time frame at below, and then you want to enter. Okay, you want to enter a short position over here. You can come down here. Okay, once, okay, now the lagging line cross above, okay, cross above, then it might be the a signal for you to TP. Okay, but if you don't want, if you want to wait until the baseline cross again, okay, then you can also TP here. That is depends on you. If you still don't want, you can refer the cloud as your resistance line, meaning to say, if the trend, okay, if this ETH cross into the cloud, this is when you take profit or you stop loss. Okay, so meaning to say, this will be the resistance line. Okay, if this is at the bottom, okay, if this is like a green line, then this will be the support line. Okay, the support line. All right. Okay, so I give you another example. Yeah. Right. If there is already a cross over here, okay, so there's a cross, the conversion line cross above the baseline, the lagging line is above the price. Okay, this is already a confirmation. Okay, but we still don't enter. Okay, we still don't enter until we see there's a cross. There is a reversal of the cloud from the red turn to green. Okay, maybe we enter here, right? We enter here when the crowd twisted. Then we enter here, goes up, goes up, goes up. It's either you TP when the lagging line cross, or you wait until it drop to the support line. Okay, when it's touch the cloud, then this will be your support line, and then you TP here. Or you only TP when the line cross. Okay, when the baseline cross below from the conversion line, only you TP. Okay, so you have three signal for you to TP when you use this. It gives you the entry signal and it gives you an exit signal. But again, you have to do your back test. Okay, set your parameter. You can start with your demo. Okay, before you familiarize with the Ichimoku. Okay, you can also do experience with day one, with H4, with H1. Okay, that is very depends on you. And this is all everything's about the Ichimoku Cloud. Okay, and then let's move on. Yeah, so I think I already explained to you because this is like a all-in-one indicator. It provide everything here. So using this, and yeah, it should most of the asset classes, anything you can use the Ichimoku because as long as there is price, as long as there's people trading, okay, there's a human behind every prices, you can use the Ichimoku Cloud and works on any time frame. But I want to remind you, you do not use it with a very short time frame because it will be just a lot of noise and then the line keep crossing each other. It will be extremely confusing. Okay, preferably day one to H4 because you want to hold your trend for longer if you use the Ichimoku Cloud. Okay, because it also help you to filter out some of the noise. Okay, and this is like a shortcut, like a hack, okay, for you if you want to snap it and you want to digest it in the future. When you can pull up your chart, you plot in with the Ichimoku. When you have this condition, it means a bullish trend. If you have this condition, this is the bearish trend, and this means do not trade. Okay, you want to catch up this, and I already explained to you what is how does it look like for a bullish trend and how does it look like for a bearish trend. So this is like a summary, and maybe you can screenshot it or yeah, just snap it if you want to use it in the future with the with the Ichimoku Club. Okay. And final remark to you guys: do back testing before you try out new strategy. Okay, you don't later after that this seminar and this webinar ends, you straight go to your live trading account and then start using it with the Ichimoku Club. Okay, I don't encourage you to do this. You backtest with some of the common thing that you trade. Okay, if you love to trade with gold, you use the Ichimoku Cloud with the gold. Okay, if you love to trade like USD, you do it with that. Okay, familiarize with the indicator, with the things that you have been trading. Okay, and perhaps you can start with a demo account. You can always register a new demo account with Pew Prime. Okay, you not like one shot straight enter with the trade with live account because that is your hard-earned money. Okay, I don't want you to simply waste your hard-earned money. You can familiarize with, okay, you can test your strategy with a demo account before you go live. Okay, stop trading when you get confused. Okay, especially when the line keep crossing each other, when the trend is too sideways, stop trading. Okay, then and Ichimoku Cloud can tell you this when there is no trend. Okay, you can plot it with the current gold prices because I believe the gold has been consolidating for the past 3 to 4 sessions already. You can plot it with the Ichimoku Cloud. You can see how confusing it is, and like you can see the line keep crossing each other. So this is also a signal to tell you that stop trading for a while. When the trend is getting clearer, this is when you enter the markets, when you enter trades. Okay, lastly, always do your risk management. You can refer the cloud to set your TP and stop loss. Even without that, pull your Fibonacci, you can also set up your TP and stop loss order. Okay, with the raw price analysis, you can also do your TP and SL well. Okay, remember it is a must to always do your risk management. All right, so here come to the end of today's sessions, and I will start to get some of the questions from you guys if you have any. What TP is best to use IC with Go? Yeah, there is no any restrictions with asset classes as long as this is like a Ichimoku Cloud, right? Right, as long as you follow the cloud, okay. So for example, here, maybe you already enter your trade over here. Let me just when you already enter your trade, but which I don't recommend. Remember, I told you guys when there is a sideway, when there is a line always crossing. Okay, one very important conditions: do not trade when the lagging line is within the actual price. Do not trade. Okay, so for example, over here, when there is a crossing and when there's a reversal, I mean when the cloud is reversed, maybe you already enter your trade over here. Okay, for example, you can always refer the cloud as your TP. Okay, because it will be now serve you as your support line. Anytime when the gold touches, okay, when penetrates into the cloud, this is when this is the final call for you to TP. Okay, but of course you're going to waste a lot of profit over here. But this is depends on you. You can also start to TP when you see there's another cross over here for between the conversion line and also the baseline. Okay, so this is one of your signal to TP, and this is the second and must exit when the price penetrated into the cloud. Okay, this is a must for you to get out. Okay, with all the patterns we learn, how can we avoid fake out? Price tends to fake out after a breakout catch. Well, this is it takes experience. Sometimes you can tell. Sometimes you can tell when the momentum is not there. This is when you need to you know with the help of RSI, stochastic oscillator, with the help of MACD, and also with the trading volume. When there is, if you trade with BTC and Ethereum, there is like a trading volume, and also gold, there's a trading volume. And you can also refer to the trading volume. When the trading volume is low, then you don't believe with the breakout. Okay, but if you look at the momentum indicator, when the momentum is very, very strong and it is like an uptrend and then suddenly consolidated, then you can kind of believe that there might have a breakout. Okay, a real breakout. Okay, but yeah, so this is like my experience, but it really depends on your experience. Some I cannot tell you from time to time because various situations have like various trading strategy. Okay, I also cannot guarantee you to tell you that this time around this is a breakout, but this time around sure there will be a fake breakout. Okay, sometimes I make mistake as well when I believe that there's a breakout, but it turns out to be a false one. But never mind, when I already know this is a full breakout, I will do the opposite trade. Okay, meaning to say when I believe this is like a bullish breakout, I already enter a long positions. If I was being full, I was being fake up. It's okay. I will set my stop loss and I made my losses, and I can do the opposite trade. I will inverse my thought and then maybe I will enter a reversal trade. Okay, so this is what I often do. Okay. Ikong, yeah, sure. You can request it from your very own account manager. Okay, they will give you a recorded versions and then you can go back and digest everything that I shared with you today. David asked like about for the Fibonacci retracement. So any Fibonacci retracement is believed it is like you believe that is like a pullback. Okay, and only when the pullback happen. Okay, so for example here, this is like a very typical double top, right? I hope that you can see this is like a double top. Okay, double top over here. And then the price reverse, okay? And when there is like a swing high and swing low, it's very simple. You put it from the swing high to swing low and you check with the momentum. Okay, if it continues, okay, if the trend continues at 61.8 Fibonacci retracement, it means that the downtrend still they still trade within the downtrend trajectory. Okay, and if the trend continues here, it means that the downtrend is kind of strong. Okay, and it is even stronger here. So this is just a double check and also a reference for your entry. Okay, if you don't want to take risk, you can enter here. If you want to take a greater risk, you can enter here. Okay, and if it's here, then yeah, sometimes we might miss out the chance to re-enter the short over here. Okay, so when there is a rebound or a pullback, this is where you pull up a Fibonacci retracements. And when there is a very obvious swing high and swing low, you pull from the bottom to the top for an uptrend, and you pull from the top to the bottom for a downtrend. Okay, from the swing high to the swing low for a downtrend, and just to check and where is your entry levels with you believe in a pullback trading strategy. Okay, that is how you use the Fibonacci retracement, right? Okay, so I believe there's no more questions. So I shall end the webinar over here. And yeah, thank you guys for coming. And I hope that I'm share good enough knowledge with you, and hope that you can use it well in the future. And I hope that you guys can start profiting after today. Okay, and wish you luck in your trading. Thanks everyone for coming, and thanks for all your support. And see you guys in the next one. Thank you. Bye bye.